Good morning, ladies and gentlemen. Rather than doing a quick run through today and seeing what we expect, I thought it would be more useful for you to have a look at what happened on Friday and why it happened, and to see what we can possibly glean about the future and the future price action. As I've been saying for quite some time, we think that everything is now centered on the positions that people have, i.e., the positions that people have held for a very long time, and that is overweight technology and underweight everything else, i.e., overweight growth, underweight value. And we think that that trade is beginning to see the first signs of stress, which can be seen in XLK and NQ primarily. XLK and NQ have done still nothing wrong. That is absolutely very important for you to realize. Has been profit taking, this has been stops, this has been all kinds of shenanigans, but what it has not been is a change in trend as yet. We really need to trade up here for a few more days and weeks to allow the market to get the moving averages up to this level, and then we see if we can break them or whether we shoot higher. Now let me show you through volatility just how stressed the market is. This is VXN, which is volatility in Nasdaq. You can see that on Friday it just had a huge spike, which took it back to the levels that it was in June when we had another panic. But it was very elevated. We did manage, though, to break back down below this trend line, which we think is very important. Any settlement above it, and we think we're in a new ball game. But it has settled above all the moving averages, so any move back down towards 1460 we think is going to get bought. That's why we think we are probably in a period of underperformance ahead for technology. Quite simply, the situation is that people have been very long these growth stocks for such a long time that when stress occurs, it occurs in their positions. And their positions are all long of these growth stocks, and therefore they're either getting stopped out, getting out, or hedging those positions. And this is causing much higher levels of volatility in technology and Nasdaq than it is in other markets, as we will see in a second. This is the VIX in S&Ps. As you can see, it's a completely different picture. The market retraced much more. It closed almost unchanged. It has turned the moving averages, so it's showing that there is stress in this market as well, but there is a lot less stress in S&Ps than there is in Nasdaq and the volatile growth stocks. Therefore, how to play defense? Well, the best way to play defense is to get out of any high growth stocks that you have, and to put your money to work in something far more conservative for the next few weeks. I have to stress that, and we will see this in the charts in a moment, people have not been selling equities. They've been rotating the sectors in which they're investing. So there is nothing as yet which says that get out of equities as an asset class, but there's plenty that says it's going to be a very volatile period for growth stocks as opposed to value plays. If you weren't here on Friday and you saw this chart, you really would have thought that nothing much has happened. The market came back. This is a chart of INX, so basically the S&Ps. It came down, tested the 50-hour moving average. This is an hourly chart, and started going back up. Very nice buy signal, buy opportunity here. 50-hour moving average with the Bollinger Band, did nothing wrong and went up. If we now go up a scale and have a look at the daily chart, and we even enlarge, we will see that we have actually closed above the Bollinger Band on the dailies. We have been above that Bollinger Band for 3 days, and we're still closing above it. All we did is retest, which is basically a rule. When the market breaks above the daily Bollinger Band, it will at some stage come and retest that level, and then it'll probably go again. That's all that happened. The market retested that Bollinger Band and closed back above the Bollinger Band. If somebody told me that that is a market which is highly stressed, I would say, what are you talking about? Yes, can it come and retrace back down a little bit? Absolutely, but it's done nothing wrong. It is still above all moving averages. It is even above the Bollinger Band. It's ascending very steeply. So any kind of retracement would actually be normal within that kind of pattern. Look at the RSIs, hugely overbought. If we go back up and have a look at all kinds of other indicators, even the monthly indicator, what has the market done wrong? Absolutely nothing. It is trading very nicely. It is above every single moving average. It has room to run all the way up to 2690 during the course of December, before it goes through the upper Bollinger Band, which on a monthly is almost never sustainable in the long term. It always comes back and retests. So the market has done absolutely nothing wrong, and this look tells me that it's going to be very, very hard to see the S&Ps below 2600. If we get the S&Ps below 2600, we know that the game has changed, and we're probably going quite a bit lower towards this next level of support around the 2460. So that's a very big move. But let's now have a look at the Nasdaq and see how that is actually changing the picture. And here we have a weekly chart of the Nasdaq, which has made a lower close for the first time in 9 weeks. We can see how far away these moving averages are. The first moving average support, which is identical to the one that I showed you in the S&Ps, is actually at 6050. So we have quite a bit of room to come down in the Nasdaq. If we have a look at a daily chart, this is a completely different picture from the one that we have in the S&Ps. Yes, this market might trade around here, but we fully expect it to break and possibly test certainly 6167, which is the 50-day moving average, but more likely than not at some stage in probably January to test this trend line and the 200-day, which is at will be somewhere around here by then, around the 5,900 level. That to us is almost certain, while the volatility that Nasdaq is showing is so much higher than the volatility of the S&Ps, and also the moving averages are so much further away in terms of support on the Nasdaq. Given everything that we have seen, we can see now that the market is establishing a pattern. Over the past several days, and this is a 60-minute chart, it has broken hard, come back to the moving averages, broken hard again, and attempted to come back to the moving averages. The moving average is here 63.75, market 63.44. So we're not a million miles away. This basically is our dividing line between being immediately bearish and being in a congestion. Every time it rallies towards 63.70, it's a short with a stop above 63.85 for the possibility of a rollover and a move all the way back down towards these levels at 6100 in double quick time. So what it has to do, it has to come down and it really has to break 6200, and then we will have a move on the way to 6100 very quickly. Next time the market is down here, even this kind of level, 62.40, 62.30, 62.50, and it doesn't hold, they will smack it. They will smack it real hard, because then this will be a third wave and the people will be getting out of their positions. It's December, markets are going to get thinner, and it's all going to be about people's positions. People are outsized long in Nasdaq components, and therefore it's far more likely that this is what they have to sell. It is important to stress that the equity market in general, the broader market, the S&P 500 has done absolutely nothing wrong technically. Not a single spread has moved an iota. The risk on off position is firmly into risk on still. Much though that we disagree with it, much though we think it's vastly overbought and discounting far too high level of growth for next year, there's nothing we can do about it. It is telling us risk on. So everything that you do should be very much a spread of going for safety as opposed to being outright short. So a spread long ES, short NQ, and basically long more conservative instruments and shorter very high beta instruments. The next logical question is, well, how far can NQ come down relative to SPY? And the answer is quite a way. So what we have here is a chart of XLK over SPY, with this trend line going all the way back to 2012. And basically you can still see that the market is in a very definite uptrend. There is no question about it. This is the 200-day moving average. This is the 50-day moving average. There's absolutely no question that this spread in the long term, as I keep on telling you, will keep on going out. We are just now in a stress period in the market, so it's absolutely normal for this position to be unwound. Well, where's it going to be unwound to? We have several examples of panics that have happened in XLK, and here we have the first one, which is in April of last year. Then we have another one around the election of Trump. Then we have another one mid-year this year. And now we're having the final one where people who basically have been long all year of this spread are now trying to get out. We think it'll definitely go to the 200-day moving average, which is at 0.23. So that is another 3%, let's call it. And then quite possibly to this support level, which we really don't think it is going to break in a hurry, and that will be another 3 or 4%. So we could see a good 6% move, more likely a 3% move in terms of Nasdaq against NQ, but certainly no more than 6. At that level, you are buyers for the long-term trend to resume. We are just saying that this is a stressed market, and when markets are stressed, people get rid of their positions or hedge them. When trying to decide and see if a trade is worth putting on, like short NQ, long S&Ps, we have to have a look at the individual components, individual main components. This is Apple, lower high, more likely over the next couple of weeks to come and retest these levels that it broke out from around the 163 level, then to try and make a new high. So really not a terribly bearish chart, there's no question about that, but it's one that says it's not going to go up too much and therefore spoil the trade. This is Google. Google had a very bad week. In fact, it had a key reversal week. It is a very toppy chart, and one where we would not be surprised if Google came back and traded all the way back below 950 in the days ahead. Certainly you would think that it'll go and retest below 1,000. It is not a fantastic chart, but if it cannot break above 1040 in the next few days, we will definitely be shorting Google. This is Facebook. Again, you can see how all these major components, all these FANG stocks that people have been long of for such a long time, are all closing, or mostly closing, at the bottom of their daily Bollinger Bands, and very close to breaking some very major levels in the moving averages, also having done a key reversal week. Now that to us has to be significant. If you hold these very high beta stocks, you really have got to take notice of what the market did. If we change that to the weekly, you will be able to see it much better. That is let's actually enlarge it for you so you can see it even better. That basically is a key reversal on the weeklies. That is saying that we will be trading around this level and lower. So you're talking about somewhere around the 165 to 170 area being the destination for this stock, and therefore it is going to help the NQ not at all. So you can see that the components, the inside components, are also very bearish and threatening NQ with an avalanche lower. And lastly, we have Nvidia, which we think is important because it's such a bellwether for the chip makers, which are such a large component of the technology sector, that we can, if you have a look at this chart, this is to us probably not immediately bearish. It probably means that it needs to do 4, 5, 10 days work around these levels before coming back off. But this is certainly not a chart that's going to provide support for new highs into year end. Basically, if Nvidia can't get up above 206 to 207, we will be active sellers of that stock, looking for prices probably down in the 160s and 150s sometime in January before it can rally again. As far as the bond markets, our view has not changed at all. The stress on Friday basically made them give up all the gains for the week, mostly. Not quite. And the Bollinger Bands are now restricting even further. There is going to be an absolute explosion of volatility at some stage, and we certainly will be buying some straddles over the course of the next couple of weeks. This is now getting to the point whereby you could see a 20% move, a 50 basis point move in either direction without any problem. As far as the US dollar is concerned, we still think we're in range. We're probably quite bottomish here. We probably need to make another move back up towards the top of this channel around 95. Maybe exceeded by a little bit towards the 95.90 level, but that is about as high as we can see the dollar going. We don't see a complete panic into year end because there's absolutely no reason for it at the moment, but certainly the longer term prospect for the dollar is very much bearish rather than bullish. As far as the biases, we certainly are not changing our bias that you have to buy the straddle in all the fixed income markets. We are certainly not changing our view that the market is hugely overbought. We are about 2610, and we could have a melt up into year end, certainly on a spread to Nasdaq. We could see the market refuse to go below 2620, 2630, and then in a few days get bought up all the way back up to 2680, 2690 as a result of the Santa rally. We certainly wouldn't try shorting the market until it makes a topping pattern. It is just not doing that. The market is stressed, but it's stressed as a result of intermarket dynamics, not as a result of equities and as an asset class being sold. And that is a very important difference to stress. Any kind of shorting should be done through NQ, which is the stress indicator, or even now the Russell 2000, which has had its spike up to 1550 and therefore is at the end of a run. The super cycle is now retracing. It's probably doing a wave 2. If for Elliott wavers, we've had the wave 1, now we're having the wave 2 retracement before the large wave 3 takes over. This wave 2 could possibly take 2 or 3 months, and therefore we'll be looking to buy at some stage. European equities are much weaker than US equities as a result of the dollar. There will be more damage here. We're just not buyers of European equities at the moment, even though they offer far more value, but they seem to be far more vulnerable on the downside at the moment. We're looking for a change for a future change in trend, and we will wait for it quite comfortably. The dollar, as we said, it probably needs another push back up towards the 96 area, but in the long term we have absolutely no doubt that it's going to go to 90 and lower. The butterfly, it is on hold at the moment. As we said up here, we are looking for a decent drop to be able to buy it in the next couple of months. Thank you very much indeed, and have a great weekend, and tweet to you on Monday.